The ability to generate a tenfold return on capital, turning $1,000 into $10,000, is not luck but a direct application of market mechanics. Richard Wyckoff codified these mechanics under the law of cause and effect, providing a blueprint for massive profits. This blueprint focuses specifically on the accumulation structure, identifying the precise moment of maximum opportunity. We aim to capture the entire markup explosion, the most profitable phase following the market's preparation. Before we dive into this powerful methodology, please take a moment to subscribe and leave a quick comment below. Even just a single word helps the algorithm recommend this video to more people, showing me that this kind of content truly matters and is worth creating. This simple action supports the channel greatly, ensuring we can continue delivering advanced trading knowledge. Furthermore, remember to return to the channel during challenging times when trading becomes difficult and your confidence starts to waver. The core strategy required for achieving a tenfold return demands identifying the absolute lowest risk entry point. This entry must be inherent to the completed accumulation structure itself. By maximizing the reward-to-risk ratio at the outset, we gain the positional leverage necessary to turn modest capital into significant wealth. Understanding this structure allows us to position ourselves before the massive institutional buying begins. The markup explosion is the period where the market delivers its largest, quickest gains. This powerful movement occurs immediately following the completion of the accumulation phase, specifically when Phase C transitions into Phase D. Our entire focus is on mastering the identification of this transition, ensuring we are fully positioned before the breakout. This strategic timing is the secret weapon of the composite operator, which we must learn to emulate. The goal of turning $1,000 into $10,000 relies entirely on disciplined application of Wyckoff's principles. The law of cause and effect states that the extent of the subsequent price move, the effect, must be proportional to the preparation built, which is the cause. In this context, the accumulation phase is the cause, and the resulting markup is the effect we seek to exploit. We must quantify the cause before attempting to trade the effect. Achieving a tenfold return requires more than just a good direction prediction. It demands exceptional risk management. A low-risk entry means placing the stop loss extremely close to the entry price. This tight placement drastically increases the potential reward-to-risk ratio, which is the mathematical engine behind our $10,000 target. Without this tight entry, the necessary leverage becomes too risky to employ. The inherent structure of accumulation is perfectly designed to offer these low-risk opportunities. The composite operator's final actions during Phase C are specifically intended to shake out weak holders, simultaneously creating the perfect floor for entry. We are looking to piggyback on this institutional maneuver, entering precisely when the market looks weakest but is structurally strongest. This low-risk entry is non-negotiable for our high-return strategy. The transition from Phase C to Phase D signals the beginning of the markup explosion. This is when institutional buyers confirm their commitment to the new trend. We must be positioned before the momentum accelerates, ensuring we capture the bulk of the move, not just the tail end. Mastering this setup is the difference between modest gains and the tenfold return we are targeting. The foundation of the accumulation structure begins with Phase A, the stopping action that halts the previous downtrend. The first key event is the selling climax, marked by a sharp drop on extremely high volume. This signifies that panic selling has reached a peak, and large institutional buyers have stepped in to absorb the supply. The selling climax often creates a deep, immediate low, marking the initial boundary of the trading range. Following this dramatic selling, we observe the automatic rally. This rally occurs when the intense selling pressure subsides, allowing the market to rebound sharply without significant opposition. The high point of the automatic rally typically defines the upper boundary of the developing trading range. Next, we look for the secondary test, where the market revisits the area of the selling climax low. Crucially, This test must occur on significantly lower volume compared to the climax itself. Low volume during the secondary test confirms that the initial panic supply has been effectively absorbed by the composite operator. If the volume remains high, it suggests that supply is still readily available, indicating the accumulation is not yet ready. The successful completion of Phase A establishes the preliminary boundaries of the accumulation trading range. These boundaries, defined by the selling climax and the automatic rally, provide the framework for the subsequent cause-building process. This initial phase shifts the market from a clear downtrend into a sideways consolidation pattern. Phase B is where the true cause is built, representing the prolonged absorption process. During this phase, the market tests the boundaries of the trading range repeatedly, swinging up and down. These swings serve to absorb any remaining supply held by weak hands or short-term traders. The absorption process is characterized by volatility within the established range, but without a clear directional trend. We look for evidence that the composite operator is systematically accumulating shares without driving the price up too quickly. This deliberate action ensures they acquire the necessary inventory for the subsequent markup. A critical piece of evidence in Phase B is the diminishing supply observed during successive downward tests. Each time the price dips toward the lower boundary, the volume should decrease progressively. These secondary tests in Phase B, showing lower volume, confirm that less and less supply is coming to market at these lower prices. This shrinking volume is the hallmark of effective absorption. This sustained sideways movement in Phase B is essential because it establishes the horizontal count base. The width and duration of this trading range directly correlate to the amount of energy built up. This measured width will later be used in point and figure charting to project the minimum vertical price objective for the markup, linking the cause to the effect. Phase C introduces the terminal shakeout, the final and most deceptive maneuver by the composite operator. This phase is absolutely critical because it generates the lowest risk entry point necessary for our $1,000 to $10,000 strategy. We must learn to distinguish this powerful move from a genuine trend reversal. The primary event in Phase C is the spring, which is a decisive break below the established trading range support. This move intentionally triggers stop-loss orders placed by retail traders below the previous lows. Following this breach, the price rapidly recovers back into the range, proving the break was false. This maneuver is often called the shakeout or terminal shakeout because it successfully clears out the last uninformed sellers. The composite operator uses this move to maximize their holdings at depressed prices before initiating the markup. The ability of the price to quickly reclaim the range confirms the underlying strength of the market. Why Phase C, specifically the spring, is the ideal $1,000 to $10,000 entry point is simple. It provides the tightest stop-loss placement possible. The stop-loss can be placed immediately below the absolute low of the spring itself. This minimizes the initial capital at risk, thereby maximizing the reward-to-risk ratio needed for extraordinary returns. Entering immediately upon the re-entry into the range after the spring offers a superior structural advantage. We are entering at the moment of maximum pessimism, just as the composite operator completes their accumulation. This tight setup allows us to size our position aggressively, knowing the risk is precisely defined and minimal. Following the successful shakeout, the market enters Phase D, confirming the commitment to the markup. The first major event in Phase D is the sign of strength. This is a decisive upward move, often breaking above a key resistance level within the accumulation range. The sign of strength must occur on expanding volume, confirming that institutional demand is now overwhelming supply. This move demonstrates that the composite operator is actively marking up the price, confirming the success of the prior accumulation efforts. This shift in market character is essential validation. After the initial burst of the sign of strength, the market usually experiences a final, smaller pullback. This is known as the last point of support, and it offers the final low-risk opportunity to enter before the full markup begins. The last point of support validates the new higher support level established by the sign of strength. The last point of support is the optimal deployment point for the initial $1,000 capital if the spring was missed or deemed too aggressive. Placing the stop loss just below the low of the last point of support maintains an excellent reward-to-risk profile. This final pullback confirms the market is ready to move into Phase E, the sustained markup. The successful identification of the accumulation structure, the cause, allows us to move into quantifying the potential markup, the effect. Wyckoff's law of cause and effect is not merely philosophical, it is a measurable principle. The size and duration of the accumulation structure dictate the minimum extent of the subsequent price movement. If the accumulation base is wide and long-lasting, the potential markup will be substantial. A small, brief accumulation structure will only support a modest markup. For our goal of a tenfold return, we must ensure the identified accumulation base is robust enough to generate the required price movement. This quantification turns speculation into a calculated probability. The primary tool for calculating this vertical price target is point and figure charting. Point and figure charts ignore time and focus purely on price movement, making them ideal for measuring the horizontal count base. They strip away the noise and clearly define the width of the cause built during Phase B and Phase C. The process involves horizontal counting, which measures the width of the accumulation structure using the columns of the point and figure chart. We measure the number of columns across the widest part of the range, usually within Phase B and C. Each column represents a specific price reversal, providing a standardized measure of the absorption effort. Translating this horizontal count into a vertical price objective requires applying the specific point and figure scale used. If each box represents $1, and we have a count of 50 columns with a 3-box reversal, the total count translates into a defined price projection. This projection provides the minimum expected target price for the markup. We use this precise point and figure calculation to validate the tenfold potential of the trade. If the projected target price relative to our low-risk entry does not offer sufficient upside to justify a 10 times return based on our initial risk, the trade is discarded. The math must support the massive return claim before capital is deployed. Position sizing is the final step in ensuring we hit the $10,000 target. Based on the confirmed low-risk entry, either the spring or the last point of support, we calculate the precise dollar amount risked per share. We then adjust the position size, potentially employing leverage, so that if the point and figure target is attained, the resulting profit reaches $10,000. This is the difference between a good trade and a strategic investment. Phase E is the execution phase where the markup movement fully develops. Trading the breakout from the last point of support initiates our position. We expect this movement to be strong, rapid, and characterized by high demand and minimal supply. This phase is the reward for correctly identifying and positioning during the accumulation. The initial markup movement should proceed smoothly, continually making higher highs and higher lows. Any significant pullbacks immediately following the breakout should be viewed with suspicion. A healthy markup trend should respect the previous structural support levels established during the transition from Phase D. Successful strategies for riding this trend involve recognizing and utilizing stepping stone reaccumulation structures. As the price ascends, it will inevitably pause to consolidate its gains. These smaller structures, often mini Wyckoff accumulations, confirm continuation and provide opportunities to scale into the position or adjust trailing stops higher. Ignoring these smaller cycles is a common mistake. These reaccumulation structures are vital for confirming the sustained institutional interest in the asset. They show that large players are taking profits and immediately re-establishing new, higher positions. We use the low of these reaccumulation structures as the new structural support levels for managing our position. We employ trailing stop management based strictly on these structural support levels, avoiding fixed percentage stops. Fixed percentage stops are arbitrary and often lead to premature exits during healthy but volatile pullbacks. A structural stop loss is placed just below the established support of the most recent reaccumulation base. If the price violates a clear structural support level, it signals a change in character and potentially the beginning of distribution. By using structural support, we ensure we remain in the trade through normal volatility while protecting our accumulated profits. This methodical approach is superior to emotional decision-making. Realizing the $10,000 target means executing a disciplined exit strategy based on the point and figure attainment. We sell the position as the calculated horizontal count is fulfilled or slightly before. Chasing the last few percentage points of a move is often counterproductive and risky. The fulfillment of the point and figure count signals that the energy built up during the accumulation, the cause, has been fully expended in the markup, the effect. Selling the position at this point is a professional, objective decision, removing the emotional bias from profit-taking. We trust the mathematical projection over market hype. Throughout the markup, constant vigilance for warning signs of distribution is mandatory. We look for extreme upthrust action, where price makes a new high but immediately fails and returns to the range. This suggests institutional selling pressure is starting to overwhelm demand. Another major warning sign is high volume without corresponding price progress, often called effort without result. If the market is absorbing massive buying volume but failing to move higher, it indicates heavy selling is occurring just above the current price. Failure to hold higher support levels is the final confirmation that the markup cycle is ending, and it is time to exit completely. The Wyckoff methodology provides a robust, systematic framework for exploiting market cycles. By meticulously identifying the accumulation structure, we locate the lowest risk entry point possible. We then use the law of cause and effect, quantified through point and figure charting, to project the maximum potential return. This structured approach is what allows experienced traders to achieve returns, like turning $1,000 into $10,000. This strategy is not about guessing. It is about reading the footprints of the composite operator. Every selling climax, secondary test, and sign of strength tells a story of institutional preparation. Your success depends on your ability to patiently wait for the perfect phase C entry and manage the position until the calculated target is reached. Understanding these concepts is foundational to mastering the market, but applying them effectively requires deep study and practice. If you are serious about internalizing the methods of the great traders, you must study the source material. Richard Wyckoff's work remains the bedrock of structural analysis, providing timeless insights into market behavior. We recommend exploring the adapted edition of Richard Wyckoff's classic work, How I Trade and Invest in Stocks and Bonds. This essential text reveals his time-tested methods for analyzing the market, determining the intentions of major players, and making informed trading decisions. It is the perfect companion to this video, translating the theory you just learned into actionable daily practice. Click the link in the description to secure your copy and deepen your understanding of these powerful accumulation and distribution dynamics today. Mastering the markup explosion is the ultimate goal of Wyckoff analysis. Use the spring and the last point of support entries, calculate your target with point and figure, and manage your risk meticulously. Patience and precision are the keys to unlocking exponential returns in the market. We wish you success in applying this potent accumulation explosion setup.